Again for joining us. Welcome to tonight's webinar on investment advice and strategic planning. Where are the opportunities? So again, another installment in our essential coronavirus business update. I want to thank tonight's panel. The panel is spread far and wide, and it's my pleasure to have these three guests on tonight. We've got Damian Scodellaro from Macquarie Private Wealth. We've got Michael Grammatico from Innovative Financial Solutions. And we've got Sebastian Mazza from Wealth Depot Financial Advisors. Now, I just want to run through quickly what the guys are going to be talking about, and we'll cross to them shortly. Firstly, Damian is going to give us an update and insight into the investment markets and try and relate this back to the world economy as it stands right now. Michael will then explain what he's seeing in the market right now and obviously questions that he's getting from his clients and how the firm are obviously dealing with the opportunities and strategies. I might add, Michael runs a Gold Coast office as well, so I'm excited to hear his thoughts on the market. For those of you who probably know, we've just opened up our offices on the Gold Coast as well, so that's exciting news. And finally, Sebastian from Wealth Depot is going to share some stories with us on some current live cases that are obviously happening now with his Brisbane clients. He's going to look at how your self-managed super fund may actually be able to support your business. And obviously discuss some retirement income strategies and, funny enough, income protection policy details, because there's been a lot of talk about that of recent times. So again, it's going to be a jam-packed webinar tonight. So please, if we run over the hour, my apologies. Please note recordings will be available after the webinar, so you'll all get that. So let's cross live now to Damian Scodellaro. Just before I do that, I just wanted to give the general advice disclaimer that obviously all the information tonight is general advice. Please, if you're going to seek extra information, encourage you to talk to your advisors directly. All right, so let's cross live to Damian. Damian, welcome. Thanks for coming on tonight. Really appreciate it.
Thanks, Michele.
So, mate, we started talking about this a couple of weeks back now, and I was probably nervous myself in the whole market, and I'm going, okay, well, I need to talk to you. I need to know what's going on. And I think the discussion was that, the investment market's dropping as a result of this whole coronavirus outbreak. So I just want you to tell the listeners tonight, what has happened in those investment markets. I know you've got some slides and things I can show up as well, but what's happened? What's been the issue?
Well, look, as you've said, there's three charts that of many that we can try and utilise to put in perspective what's been going on in financial markets, and that's right across the board. So, the first point to be made here is, investment markets, whether they're equities, bond markets, fixed income markets, listed property, infrastructure have all fallen significantly on the back of what has gone on. To be quite frank, markets were, especially in equity markets, were what one would class fairly, if not fully valued prior to this. We just needed a black swan event, as they call them, something from totally out of the blue to arise. In fact, there were a number of issues out there, whether that was Hong Kong demonstrations. Obviously, coronavirus came totally out of the blue back in January, February, and has obviously exploded in developed markets in March. So, putting it in perspective, you can see there the charts, the decline in the US, which is the S&P 500, the 500 largest companies in the US, has fallen 34% as of yesterday afternoon from its highs. Back in 08, 09, that was the GFC, where you saw about a 57% decline, and then the tech bust back in the early 2000s. So it is just trying to put it in perspective how far especially international shares have performed over the last decade. Conversely, on the right-hand side, you can clearly see Australia's market, which has just pretty much broken new highs in February, has pulled back 37%. So, to put it all in perspective, the pullbacks that we're having in investment markets, especially equity markets, is normal. The only key difference here And Michele, you might want to go to the next slide. Or maybe, sorry, the next one after that. We might have skipped to, no, this one here. The main thing here is the velocity and how fast it's actually unfolded. Here you've got, the three last bear markets. So in grey, 1987, the pullback of the GFC and how many days. So on the bottom axis, it's showing how many days did it actually take and what percentage pullback has happened. So you can clearly see there in light blue, it's been a pretty dramatic pullback in the underlying market in a very short space of time. And I think this is due to the fact of fear of the unknown. Markets were fragile already. So we've seen it happen really, really fast. And I want to just say volatility has not dissipated in any shape, way or form. Yesterday and today were clear-cut examples that the market, put it this way, hasn't found a level that it's comfortable with. You haven't really started what I'll talk about later as sort of like a consolidation phase. But put it this way, whatever we're going to call this COVID-19 pullback, it's been fast, it's been quick, but we're not expecting it to bounce back exactly in the shape, way, and manner that it's fallen, put it that way.
And I think, obviously the question out there from probably our listeners is that, we're all asking probably when is the bottom, and obviously, can it get any lower? In your slides, it seems to suggest that.
Well, look, we've got to answer what started all of this. It's ultimately a medical emergency. COVID-19 is what was predominantly the cause for this pullback. So until the medical emergency is solved, we can have governments throwing as much money as they want at investment markets, at the economy. We really need to see a solution to the medical problem and a resumption of what one would call normal life. I must admit it's interesting to see in North Asia. So, I'm not going to use data from China. I'll use data from South Korea and Taiwan and Singapore. Look, we are seeing things approaching somewhat normality at the moment. But look, they're 6 weeks, 7 weeks ahead of us. I put it to clients that we haven't even entered the tunnel of COVID-19. Yes, it's been 4 weeks that I've been working from home, but I envisage that to be much, much longer. So just getting to the point here, have we found the bottom? We've got a chart here that just looks at valuations or a price to earnings ratio of shares. In that orange line, you have the 20-year average. So you can clearly see pre the pullback, you had price to earnings ratios that were well and truly above average. And this has obviously brought markets back down to one wouldn't call cheap levels, because you can see there during the GFC, it got much lower. But as I say, this is a medical emergency rather than a financial emergency. So look, I just want to say, markets, especially bond and equity markets, move from what I call a destruction phase, which we've probably seen the majority of it all, that all assets fall in unison. We're now sort of at that second stage that I call consolidation. And that's where the severity of the downturn is better understood by businesses, better understood by investors. And that's probably where we're seeing ourselves at the moment. The last couple of days, barring today, is seeing the biggest rally since the Great Depression, upwards in markets. So look, that's not to say this drama's over. I think we're in that consolidation phase that everyone has to get comfortable with what COVID-19 looks like, or the economy after COVID-19 looks like. And that's before we get the final stage, which is very much the recovery stage. And to be frank, you need your portfolios set and invested before that recovery starts, because by then equity markets credit markets are going to be going for a very good rally, put it that way.
So we've still got a way to go here, and obviously going to see a bit more drop off. But I just wanted to ask, there's a question here from Philip. He says, how long did it take markets to get to their pre-9/11 levels after the attack?
If you go back about 3 slides, Michele, I'll sort of, there's a chart which will actually, so I'm actually comparing what's happening at the moment to a 9/11 case scenario. If we go one back more, no, we don't have the chart. 9/11, you know, was a terror threat. You know, it shut down New York for about a week. From recollection, 9/11 impacted the US market for over 6 months. But there were other implications from that, you know, just looking at what happened with oil throughout that period. We haven't seen it at our petrol pumps, but, you know, oil has fallen by over 50%. And that's not due to COVID-19. That's due to the Saudis and Russians, quite literally, not olive oil, physical crude oil. I saw that pop up. Crude oil has fallen by that. So, look, I envisage the market not to be a V-shaped recovery. There are sectors of the economy, and if you look at even small businesses in Australia, it's not as if you're going to come back to business as a coffee shop or a manufacturer and suddenly put your 20 employees back on. You know, that's where investor confidence, that's where business confidence, consumer confidence will probably lag. And that's why we're not looking at, you know, a V-shaped style market. We're definitely looking at, you know, I would call it like a Nike tick, a sharp movement down and a slow retracement back up from there. Okay.
All right. And so I think, you know, you touched on opportunities. You know, there's obviously opportunities presenting themselves now in the investment markets. So what sort of things are you saying to your clients at the moment?
Well, you've got to divide client bases into two. There are those that are looking for the short-term opportunities, of which I think there are a number. I just mentioned before, you know, last week saw the biggest percentage rally of the Australian and US stock markets since the Great Depression. So we've got a lot of volatility still out there. We've got a lot of companies that are yet to report, and some of them are going to have good things to say. You know, if you think about technology, entertainment within the technology space or gaming, when you look at healthcare, you know, if I'm Johnson & Johnson CEO, I would not want to be out there saying coronavirus is the best thing that's happened to us in the last decade. Your PR team would be saying, do not say that. But the fact of the matter is opportunities like that in healthcare, opportunities in thematic investing are definitely there. So if you're a trader, this is probably the best opportunity we've had in a decade because of the volatility. But even if you're a long-term investor, I've always utilized 2 quotes here, and one's by what you call Baron Rothschild. You know, the Rothschilds are one of the richest families ever. Their favorite saying back during the Depression was, you know, buy when there's blood in the street. Look, my problem is there's definitely blood in the street. It's ankle deep probably at the moment. I don't know whether that rises up to knee deep, but there's definitely quality assets that can be bought at distressed prices. But on the other hand, there's Maynard Keynes who made it quite clear that, you know, irrationality in investment markets can last longer than economies can remain solvent. So, look, it's balancing that up. I think if you're buying quality businesses who have got stable earnings that are in the right sectors, you know, I think we'll come out the back of COVID-19. Look at Zoom, look at Microsoft. You know, we're moving a lot of things in technology. I think this has actually brought, you know, the change in technology forward at least 5 years. So if I'm a Microsoft, if I'm a Visa, so electronic payments, if I'm an entertainer in computer gaming, Activision, Blizzard, esports and the like, you're a net beneficiary of what's going on at the moment. Unfortunately, there are going to be losers within the financial space. So you just got to pick and choose where you're going to place yourself.
It's so true. I mean, it's a tech revolution out there. That's what's going on. And those that can adapt quickly will survive. Those that haven't are going to get left behind. So, interesting to hear those thoughts. I might think about some tech stuff out there. But again, Damian, thanks for giving your time tonight. We'll cross back to you live with a few more questions. There's questions coming through as we talk. We'll try and answer those as best we can. I'll just, for sake of time, just want to move now over and join in with Michael. So, Michael, you there, mate?
Yes. How are you?
Yes, Michael, thanks for joining us tonight. Michael, so obviously, the reason for tonight's webinar, and I've tried to sort of spread it out so that we've got yourself dealing with obviously Gold Coast clients, Sebastian dealing with Brisbane clients, and Damian giving us a sort of more overview of the whole market. But I think the things we were talking about the other day, what you're seeing, I suppose, is clients are coming to you and they're going, well, now this is all upon us. Do I need to change things? What am I doing? Do I have to reset things? So, what are you seeing in your client base at the moment?
Yeah, I guess I'll preface that as well by saying, regardless of me being on the Gold Coast and Sebastian being in Brisbane, I think what we're probably seeing is uniform. And I'll also preface it by just a little bit of commentary. A lot of people are calling for complete lockdown, right? It's important to understand the implications of that. We're constantly looking at the health data, and although a number of countries in the world are showing really concerning data, the measures that the Australian government have put in place to they're starting to show signs of impact through the reduction in new cases throughout our country. And I guess a complete shutdown can cause further issues for obviously unemployment, someone's ability to earn an income, impact on businesses. So, I think the government are doing what they can to avoid this outcome. I was listening to one of Australia's most prominent portfolio managers yesterday, and he put things into context with the potential levers that obviously the government can pull for stimulus in response to the health situation. And I know in some of the updates that you guys have already done, Michele, yourself and Canyo, some of this has come up already, but obviously bailing out of businesses because of their loss of revenue. So what does that mean? It's going to reduce unemployment. It's going to give businesses the ability to continue and not close when their restrictions are lifted. Number two, partially bail out businesses. So the gap then is shared between society and the government's balance sheets. And then three, compensate workers up to 70-80% of their income. And then that gap then falling on businesses and landlords and governments. There's got to be a balance in all of that, I think, and that's important, for the government to find that balance and get that right. But to go back to your question, what am I seeing? A lot of the questions that are coming out from my clients are exactly this. Based on my goals and objectives, do I need to change anything? No, the first thing I'll say there is don't make any decisions without the appropriate advice. And I don't mean advice from friends and family when it comes to your financial situation. I mean professional assistance, whether it's myself, whether it's your own advisor, whether it's Sebastian, Damian, Michele, you need to seek professional advice in a situation like this. We're talking to our clients about understanding their own cash flow, need versus want. What's a luxury? What's a necessity? What does your budget look like in this new environment? Obviously reduced costs, but more than likely and potentially reduced income or loss of income. Making sure that budget and that banking structure is right, knowing what's coming in, what's going out, and whether or not you need to tap into benefits like, capitalising your P&I payments for 6 months. That's obviously been something that's come come to the forefront. If you've lost your job, does that job keeper stimulus help you? Maybe that last resort of that $10,000 withdrawal from super. But it's really important to understand the context and realizing, okay, well, what's changed in your situation, or has anything changed in your situation? Because this will be the most important information that'll determine whether or not you need to make changes. Are there any short-term capital needs? That'll play a part. Where do you get these funds from? Where are you going to sell your house? Have your plans needed to change because of the situation? Have you had to cancel your holiday? Are there health issues that you need to plan for? All of these scenarios are reasons to adjust the strategy and allow for a change in short-term goals. So allowing your financial plan to be adaptive is important, and it's important especially at the moment.
Michael,
if there's no change to the situation,
yeah,
and your long-term goals remain the same, then it's important to address your current strategies. It's important that your advisor re-explains your goals and strategies that are helping you achieve, your goals and how it's relevant to your situation.
I think
that probably leads me on to that. Sorry.
Yeah, the point you raised before about getting the right advice from the right people, because I think it's part and parcel of why Kanye and myself have gone to live webinars like this to try and get to our client base, to give them obviously the information firsthand and break it down into plain English. There's a lot of noise on TV that people are seeing in the news, and generally every day it's how many numbers have died and how many new cases and all that sort of stuff. But the reality behind it all is that, hold on, we still need to live, we still need to work, we still need to continue our lives. So, talking to the neighbour down the street about something, again, who has no professional expertise in a specific topic, can be detrimental. So, agree 100% with your comments there, based on, people talking to you and making those changes. So that's awesome. And I think, the question about volatility, market volatility, and Damian touched on it before. The questions around the strategies being still relevant. Well, of course, that's a big decision that you guys are probably working through right now.
Yeah, and agree with what you said. Having that conversation down the street, and John from down the end of the street is 60 and he's approaching retirement, and Peter at the other end of the street is 40, and they're in different financial positions. Their attitude and appetite to risk is different. You can't rely on that whole mentality of the barbecue conversation. We talk about it a lot in our world, because that barbecue conversation gets people thinking about, oh, am I doing that right? Am I doing that right? And this is where your professional advisor can deep dive into your strategies that you've implemented, or in some cases, for those people that haven't sought advice before, and assist in educating you on the current conditions, with new strategies coming into play from the recent release of stimulus by the government. And it's a perfect time to seek advice. Over the last 2 weeks, I've been conducting, a lot of review meetings now via Zoom, to keep not only our staff but everyone protected. And I guess I'll give a couple of examples. I know Seb's going to talk a little bit about some of his client stories, but late last week I was talking to clients of mine that are in their early 40s. They've got investments with debt against those investments, as well as a superannuation portfolio that is a high growth risk profile. And they've seen impacts on their balances on paper in this review. And I stress the fact that we talk about the impact on balances on paper, because that's a really important point. And through the conversation and a reconfirmation of their goals, which are all long-term, they understood the need to allow the market to go through the cycle. They understood that if they were to sell down some of their investments, it's going to crystallize their losses. So through the education process, they actually saw the current environment, and obviously just drilling down a bit further on what Damian said, they saw the current environment as an opportunity to invest more money, as they felt that they were, or we could find some discounts on some investments, and it would provide them for a better opportunity longer term for growth for their retirement. If you show that slide, Michele, that Zurich bear versus bull markets, the next one, this is a really good slide to just look at over the course of the last 50 or so years. And just for definition purposes, a bear market is obviously a market where share prices are falling. A bull market is a market where share prices are rising. You'll see the average bear market duration of 14 months and the average annual bear market loss of negative 42%. And then it shows you the average bull market duration, 80 months, and the average annual bull market return of 27.8. So, there's some good examples there of us coming out of bear markets. Specifically, you look there, 89, between 89 and 92, we saw a bear market, and then coming off the back of that, a 202-month bull market at 987%. This is data that, hey, I'm not going to say it's the be-all and end-all, but it's good indication for us to kind of think about what the future may hold, and reiterating again what Damian said. On the other hand, I was conducting a review with one of my retiree clients yesterday who's concerned about the impact on her account-based pension income. And we spoke about her portfolio, her risk appetite, and she was more comfortable as she knew that her monies were diversified and not completely exposed to, the market volatility. And we discussed a number of strategies that could help since the release of the stimulus package. And she decided to reduce her minimum pension income so she wasn't drawing as much to minimize the impact. And she had cash reserves to top up that income over the next 6 months. But also she said to me, well, Michael, because I can't go out and I'm living in isolation, my expenses have reduced. That need versus want, that luxury versus necessity piece. So it's important to understand what your investments are made up of, and most importantly, your attitude and appetite to risk, which will best identify how you should be invested. What asset allocations do you have? And what I mean by this is what is the makeup of your investments? What percentage is allocated to growth assets like Australian and international shares and property and infrastructure versus defensive assets like cash and bonds, fixed interest, like Damian was talking about earlier. So if your situation has or hasn't changed, making sure that your asset allocation is still appropriate to meet those goals. And if you do decide to change, it's very important for your advisor to educate you on the consequences of any potential change versus staying the course. Damian's talking before about that Nike, that Nike approach and the Nike as opposed to that V-shaped recovery. We talk a lot to clients about time in the market versus timing the market, especially for those longer term clients. Go to that other slide, Michele, that emotions of investing. And this is how a lot of us could be feeling at the moment. As markets rise, we see optimism, we get excited, makes us want to think about throwing more money at the market. And as you can see at the top end of that market, that's the point of maximum financial risk. As we come off that, this is where anxiety starts to set in, denial, we're starting this fear, this panic, and that's where everyone is at the moment. We don't want to run the risk of trying to time the market. And that's a really important point to be aware of. I'm not saying here that I'm not saying don't get out. If your attitude and appetite to risk doesn't allow you to handle these waves, as long as you get educated to a point where you understand the implications of doing or making decisions. You know, I talk a lot about, it's not just, you don't just seek advice from me when markets are doing good and we're implementing strategies for you in good bull markets. My job is to stop people from making silly decisions in volatile markets as well. So, yeah, does that answer that question? I think that answers that question.
I think that's awesome, Michael. And you know, like, it's interesting talking, you know, to yourself and Damian and Seb about these. I mean, like, looking at that Zurich chart, you know, we talked about sort of September 11, and I suppose if you look at it since 92 through to 2007, we've been on this climb, and you know, it's been an awesome climb. There's been a lot of you know, happiness, I suppose, in that period. And then, you know, I would like to see probably maybe you might be able to send a slide of current data which shows what's happened now, because the thing is, if you look at it, we had a drop just before, I suppose, September 11 happened, and then obviously since September 11's happened, it's been a slow rise, but it has been rising in a situation where there was a lot of turmoil. There was all this stuff happening in Iraq and Afghanistan and so forth. So maybe it's not all you know, as much of a problem as we think it is, but you know, obviously it's different circumstances. So yeah, I think if you've got something on that you can share with the panelists, with all the team people on live tonight, later on, that'd be brilliant. So yeah, I think you know, obviously the questions people are asking about the risk profile and also asset allocations are very important, and I think also it's, like you said, education is important, right? You know, if I personally decide to get out of the market and cash up, well, I need to understand the ramifications of that, you know. And I think what happens is a lot of people do that, but then they forget to jump back into the market when things turn around again and make decisions. So, you know, I'm talking for myself personally. Everyone's got obviously their own agendas and their own investment, but again, you know, talk to your advisor and make sure you get the information right and you understand. So that's cool, Michael. Thanks very much for your help there.
Happy to share.
Awesome, mate. All right, let's cross live now to Sebastian. Sebastian, so thanks for waiting there in the wind there with the other guys. Tell us, you know, you've gone through again the same thing. The last 3 weeks you've had, you know, a world of pain. You know, everyone that I talk to is all suffering. You know, there's no stories out there where people are actually going, you know, this is brilliant. But before, I suppose, I just touch on something, I just wanted to mention, I think that, you know, obviously the speed of information and obviously the use of technology to communicate with people, I think we've seen, you know, just grow exponentially in the last couple of weeks. So that is obviously important. It is important to get out and give information to people. But so tell us, leading on from that, you know, the stories that, you know, we can relate to, I suppose, that the clients are going through, following on from what Michael said.
No problem. Well, thanks for having us on tonight, Michele. It's been, you know, it's a good opportunity for us to I guess, you know, get our stories and get our client stories out there, so those that can, who aren't reaching out just yet or haven't been able to be contacted just yet, can get a feel for what's happening on the ground and you know, in terms of our front line, you know, what we're trying to impress on our clients and our family and friends about what is happening, just like Damian's expertly explained, and obviously as Michael's explained there about what we should be focusing on day to day regarding our own objectives and our long-term plans. So I guess with a lot of the contact we've had with clients over the last few weeks, we've been across the different, I guess, client segments. So we've had, you know, retirees, pre-retirees and accumulators all have questions or all have concerns about the uncertainty, about what their super balances are doing, about job security, about where they're going to get their income from, be it from an income stream out of super or purely from a wage. So when we sort of break it down and sort of work out for each of those segments, we are seeing some, you know, trends, I guess, and certain questions that are being asked and scenarios that have been playing out. Obviously, for our retiree clients, it's definitely more about that income stream and that need to feel safe, to have a stable income stream to support themselves. Because that's been the plan over the last 30 odd years, is to be self-funded and to rely less on the age pension for a safety net. So we've got a lot of clients that are now moving into that position, being recently retired and using their capital to support themselves in retirement. And here we are, with a bit of a bear market, and also like Damian has said, and Michael's mentioned as well, that we don't feel that we've seen the worst of it just yet. There may be some worse days to come as more data is released, and in the fight against that infection rate carries on. But what we're trying to obviously provide our clients is an opportunity to impress them with. We don't want to make rash decisions. We want to make decisions that are based on their immediate objectives and long-term objectives. So we need to focus on, if we need to rebalance their portfolios, we need to sort which parts of their portfolio should we be touching, and not looking at it as clearly as a proportional drop potentially. So with our retirees, liquidity is a big factor for them, and finding out and trying to work out where they're going to cover their income from. So we're looking at different ways to provide that liquidity for them, because they want certainty. They want certainty around their income streams. For our pre-retirees, for those that are obviously self-employed or have loans or have that uncertainty of knowing potentially where the revenues are going to come from, we want to focus on the measures that are available to get them through this period of time. Whether it's going to be 3 months, 6 months, 12 months, we all don't know that question just yet. But we need to start working on our cash flows, like Michael's mentioned as well. And we need to start working out what are the essentials and what are the non-essentials, and making some decisions around that so we can plan forward. For our accumulators, I guess these are the cohort that job security is probably their main priority right now, and providing for their family, making sure they can put food on the table and cover the loan repayments. And for them, that's what their concerns are. So their questions are all about, what income support can I definitely access? Should I lose my job? And if we're self-employed, where are those measures coming in for us to help support us? Because my turnover or my revenue of my business has actually dropped significantly. But I don't want to dwell on all the negatives. This is a time or an opportunity for businesses, even for employees, to take a step back and even potentially look at their businesses and their own skill sets and reskill, and improve their position in the market, so then they can then, potentially take the best leap forward when, things get back to normal, and be in the strongest position compared to their peers. A lot of businesses are obviously doing some great things in the hospitality, restaurant industry. So in terms of still continue to develop strategies to get goods and services out to their clients. And I think everyone has to focus on that. So there's sort of the client stories that are coming out. One of the beautiful things about the clients that I have at Wealth Depot, I'm sure Michael can attest to this, and Damian, is that we have such a vast array of clients, from the 20-year-old that just come out of uni into his first job, up to the retiree who's just looking to get by day on what they have, and everyone in between that provides those opportunities for us to impart our knowledge and educate and make sure that clients are making calm, rational decisions at this time, I guess. So so that's pretty much where what the feedback we're getting and what we're trying to obviously press on our clients. It's time to consolidate, to get their house in order, get their debts under control as much as they can, work out what's possible, what avenues, what options they have, and try and put those things into action.
I think that mentioned about the risk, is important. Look, I think we've had there was a thoracic surgeon that I know who has basically thrown in the towel to go and retrain as a nurse to help in ICU rooms and things. So, it's again a call to arms. People have had some different ways to innovate. So, it's important. I wanted to probably just mention this just before we sort of roll into that self-managed super fund question. But news today from the ATO for our perspective, the early release of super. Now, I know we talked about that, all three of us, four of us talked about it the other day, and how we're thinking that this could have a detrimental effect on the situation. But just wanted to let people know that the early release of superannuation can now be accepted through MyGov from the 20th of April. Now, I'm not out there advocating that people do that, and I don't think that that's the case. But the reality is if you are fully affected by this, then you are able to potentially get early release to that. So again, that'll be a question, I think, for the panel once we've finished, Sebastian. But can you just elaborate a bit more on the self-managed super fund supporting business? How does that sort of work?
All right. So as many of my clients know, and obviously many of our clients have self-managed super funds, I thought it'd be a great opportunity just to really hone in on some of the things that self-managed super fund trustees can consider, depending on their obviously personal situation. And this SMSF structure, not just provides flexibility and control in the accumulation phase or the pension phase, but also around your investment strategies. And right now, where cash flow and liquidity are at the highest regard, having an SMSF involved with certain investment strategies. So those clients who may have business real property or commercial property that's leased from their super fund, or where they have related party loans, or even when the super fund that they have has liquidity that they can maybe access. There are a few things that they can definitely try and see what could work for them. So just to elaborate, so with everything that's going on between commercial landlords, residential, obviously, property owners, rent reductions are mightily being negotiated right now. And those things are definitely going to be at the fore for self-managed super fund landlords as well, where if they've got a related party leasing their property, they too can obviously offer those rent reductions, which is going to then prop up the cash flows of the business to allow them to get on and keep maybe staff, keep their lights on, and keep delivering goods and services. The point to note around all this stuff, though, it's all about the documentation. It's all about knowing that the compliance rules haven't gone away. There's still things that need to be considered, but the ATO have at least come out and publicly come out on their website to provide a bit of a reassurance that should trustees decide to do certain things that may not be at arm's length or to the exact code of the sole purpose test, that they're not going to come after trustees over a period of time. And that is this financial year and next financial year. They will allow some grace around that. So it's important to understand these options, especially our SMSF clients who probably don't know where to go or if they can go anywhere or can maneuver any levers. So the rent reduction thing, opportunity is important. The other one about if they've got a limited recourse borrowing arrangement that's being funded through a related party arrangement, is that, again, the SMSF can look for a deferment of payments to help relieve the cash flow burden for the self-managed super fund, because obviously its rents have been impacted. So all those things can be at play. And the main thing to focus on is compliance is still there, documentation has to be up to scratch. But if we've got those clients out there, be it our current clients or any clients that have these structures, but they need that assurance and that understanding and that advice, is to reach out. I'm sure Michael's over this and whatnot. So we can have these discussions with clients. And the third one that I wanted to mention was if your self-managed super fund has liquidity, so it's sitting on maybe some good cash reserves or has the ability within its portfolio to access cash quite easily, that a lot of people sort of are aware of this particular allowance and in the legislation, that the super fund can actually invest or lend up to 5% of the total assets of the fund to a related entity. So that could be an initial, first up, ability for any business to gain some cash funds to keep them working, keep the business propped up, and to keep moving forward. And as long as everything's done, again, according to a documentation, that everything's in order, and that you've got the correct advice, that's all about your personal situation and objectives, then these things can be considered. So I just wanted to definitely mention those tonight, just in case, those clients out there that may be thinking of a self-managed fund right now, for whatever reason they're considering, that also these type of measures are also available to them immediately. So yeah, I just want to mention it tonight.
At the moment, still systems go, right? Still everything, as is. But I think what's going to be important in the next couple of days, hopefully tomorrow we have some sort of outcome from government, because I know, a lot of clients have got property in their self-managed super funds. So,
residential,
if they're not going to get residential rents or commercial rents coming through, and they're going to have to negotiate, I think that's going to have an impact on people as well. So, yeah, we're trying to keep abreast of it. We'll hopefully have, as soon as we have some information to hand, we'll probably come live with another webinar, hopefully on Tuesday, to fill you in on, I suppose, the logistics, the legalities, and how to sort of deal with it, because it's an unfolding space. And I think, I put through that webinar last week with the real estate agents, and if they're out there listening tonight, obviously things have changed in the last week. Things will continue to change. So, it's important that I think government make the right decision on this one, because it's going to hurt, I think not just property owners, but it'll hurt the real estate industry as well. So, All right. I think we'll probably just finish up on those 2 points there. I think you wanted to talk about retirement income strategy.
Yeah, I just want to touch on that, and just obviously again, it's all about educating and helping people to understand their options and what they can be doing or thinking about if they're in a situation where they have their retirement income plan in place, but obviously now with what's happening, and obviously the government is trying to do their best to relieve those pressures on clients and their income stream needs. So a couple of the measures they brought out were the reduction in the deeming rates and how age pensions are calculated in terms of the income test. So with the reduction in the deeming rates, that's potentially allowed age pension recipients to receive more age pension, or even for clients who weren't receiving age pension only a month ago, potentially, to now be maybe receiving the age pension. So it's all about identifying those opportunities and strategies to ensure that you're maximizing, obviously, your income streams. The other one was they've also reduced the minimum pension drawdown rates for pension phase members in super. And that can play out a couple of different ways. Obviously, the first one is that, like I think Michael mentioned this, is that you don't have to draw down as much, and that's going to allow your portfolio to stay intact, especially if you're maybe have a growth strategy in place, because you don't want to be selling growth assets in the current environment. And two, that you've got the ability to use the levers within superannuation to say, well, if I've got an opportunity to take less out of my pension account, which, as we all know, is tax exempt and virtually a quasi tax haven, if you've got those assets in that pension phase, that you can retain your assets in that account for a longer period of time, and maybe utilize some other funds that might be sitting in an accumulation account to prop up your liquidity or income needs as you need it. The other thing too that's come up in a lot of our retiree conversations is about stability, income stability. And we don't necessarily use a bucket approach. There is a bucket approach in terms of working out how much liquidity we'll need over 12 months and 3 years or whatever. We try to work on in an individual personal level. So we're working out the levers that are available to you: your account-based pension from super, your entitlement to age pension if you're in that position. But with your account-based pension and in market conditions like we have right now, you sort of lose that certainty and stability around your income streams. So we're talking to clients a bit more about things like lifetime annuities that provide that stability over any market conditions in terms of income streams. So we're just wanting to throw these concepts out there, and whether they're going to be appropriate for anyone in particular, we can then have a look at those things and look at your individual objectives and your needs, and your capital to see how far you can travel with those capital items and to provide that income stream. So yeah, that's all I wanted to sort of make sure people are aware of.
Okay, cool. And the question about income protection policies, what are they really covering? So interesting one that you've had come up recently as well.
Yeah, that's right.
What are we talking about there?
So it's obviously people who are holding income protection policies or disability income policies in their super funds, obviously are trying to work out or have a connection between, well, if I lose my job, this policy will replace my income. It's income protection. However, income protection policy is all about protecting you should you suffer an illness or injury that prevents you from working, and then you can then rely on those benefits to provide an income stream. Unfortunately, for the clients that may be made redundant or have their work hours reduced purely because of self isolation or shutdowns, can't rely on their income protection policies per se, unless they do meet one of those claimable definitions. However, in saying all that, insurance companies do have some levers available and offer things like involuntary unemployment premium waivers. They can offer you to stop paying your premiums for 3 months, but still retain your cover. Premium holidays, so that's where you might just actually put your cover on hold for up to 12 months, and you can then restart your policy at any time within that 12-month period. But please note, cover may cease during that period. And a lot of the insurance companies are providing well-being and health reward type of programs to help support clients in this time of anxiety and stress, and also to provide actual premium discounts. So there's an ability there to really jump onto these programs and use them now more than ever to help keep costs down of your insurance policies, and to get the most maximum value out of them in terms of these programs and these benefits that are available.
All right, cool. So, I can see how people would probably think, if I've lost my job, maybe my income protection policy will kick in and keep me going. So, I can see how that's confusing.
Yeah, it is.
I just wanted to mention as well, I was part of a podcast last night with SMSF Advisor, and, I was talking about, the industry, and obviously like the fact that, the rapid transition of the super industry as well, people working from home with this coronavirus pandemic. It's basically meant that us as accountants and you guys as advisors and administrators have to be more available now, more so than ever. And it can't ring true. I mean, there was, I think I had an article published today on LinkedIn channels, and, talking about, the social impact, and obviously the fact that we've got a lot of medicos out there and a lot of nurses and a lot of people in the health industry, doing their part, and hat off to them. Congratulations. Keep it up, guys. On the other side, you have people like ourselves who are dealing in the front line as well, because again, we're dealing with people's livelihoods and businesses and income streams. So, obviously on that counselling side, trying to understand that this is a huge impact, and we have to be all there available to help. So, I look again. I want to thank the guys for coming on tonight, being part of the panel. I think it's been really informative. I've got a few questions here, so stay with us. First question here to Sebastian. Sebastian, one of the guys has asked here, have you actually read all those books behind you, or are they just for decoration?
No, I have read. I enjoy reading. And I don't do it as often as I like these days. But most of them have been gifts. I've got a different array of books here. It's pretty cool little library. I'm very proud of it, and I definitely enjoy reading.
All right. A question here. So, what about if am I able to pay my pension? I'm assuming from the super fund with no income from rent.
Well, yeah. I mean, obviously, if you've got no rent or income coming to the fund, then you're going to be relying on obviously income streams from any other potential investments. And if you don't have the ability to pay your pension, then you need to consider, do you stop your pension, number one? Number two, how much pension have you already paid this financial year? and then work out whether under these new reduced deeming rates, if you've already met your minimums already. So you just got to work through that and see where what options you have at that point.
Okay, I've got a question here from Stephen. He said, "What's likely to happen to the AUD from here?" I want to answer that.
I think Damon's best for that.
Look, a contentious point here amongst economists. Economists are usually behind the curve with what's going on. To put it simply, that 55 US cents that we hit is probably the baseline for the Aussie dollar. So it's probably a low. It could be retested again. But with the rally we've had, we've got to understand that central banks, both the Fed and the RBA, are now stepping into currency markets to stabilise it. If you imagine you're an importer-exporter, you don't want the Aussie dollar being 61 cents one day and then 55 in a week's time. So reserve banks, central banks are going to be stepping in to stabilise the Aussie dollar versus the US. But look, now that everyone is on monetary, stimulus, you're going to see the Aussie dollar probably stabilise around these levels. I don't know if it will retest those lows, but for clients at the moment, we are hedging US and European holdings. So hopefully that explains the question. We do believe the Aussie dollar, once this is all over, could retest those 69s versus the US dollar.
Okay, cool. Question from Michael. Do you think that I need to reassess my risk profile as maybe I was too aggressive?
Yeah, I mean, it's an interesting question, isn't it? And it'd be completely dependent on the goals and objectives. I mean, depending on the strategies, if that person is a lot younger and has a long-term time horizon, it also depends on that person's, we're talking about the emotions of investing before. If this current environment and the volatility that's going on at the moment is making that person feel anxious and have that fear, then a discussion needs to be had around whether or not they're sitting in the correct risk profile. But I mean, without that education, I'd be saying there, don't jump and make a decision without advice. Don't make that call without appropriate education, because if you do that, and you have the ability to withstand and ride these waves, then you're going to be in a better position than selling down and crystallizing those losses. So case by case scenario, seek advice, and that will then give you a better ability to determine your accurate risk profile.
Yeah, I think it's right. Look, each case is different. So that question's dependent on obviously each person's situation. There's a question here, this is probably for all of you. At the moment, obviously this is caused by a medical event. The economic event is yet to come. How deep and far do you feel this will be?
How long's a piece of string?
Big question, eh?
It's a good question. I mean, obviously, we've been talking about it tonight. There's two big things that we're keeping an eye on. One being peak infection rate. When we start to see that curve flatten out, that may provide a bit more stability in markets. The second piece is the economic stimulus packages, and that's the big piece. Corona has not discriminated. Unlike GFC, central banks got the opportunity to pick and choose who they were going to bail out. The central banks now, there is no discrimination. They have to bail out or do their best to bail out everyone. But, like we've seen over the course of the last couple of weeks, hospitality industry decimated, entertainment industry decimated. These impacts are far and wide, and we're right. I don't think that we've seen, the complete impact yet. I think the economic impact is yet to come. I mean, Damian might be able to throw 5 cents worth in being closer to the forefront, but that's opinion. And that, I'm on a webinar like this every day with market updates, so that's That's my 5 cents.
Look, the economic consequences of this are going to go on for a long period of time. I think we've got to acknowledge the bad economic data will be coming out in this coming quarter. It's going to look pretty bad. It's already looked pretty bad, but it's going to look very bad. I think the bigger issue is how society changes from COVID. Let's look at what's happening. We're trying to flatten the curve with social distancing, but that doesn't change the surface area of COVID-19. It won't change how many people are actually going to catch it. And this is where there's a delicate balance between can our hospital system contain COVID-19 without it falling apart? But at some point, let's be frank, COVID-19 vaccination is a significant period of time away. Suppressants against COVID-19 might come sooner rather than later, but it's a virus that's going to be around for a long time. If you do look at South Korea, they are still social distancing to a lighter degree. My bigger issue is COVID's going to change the world as we know it quite substantially. Moving on, there's going to be winners, there's going to be losers, full stop. So it's going to be an interesting world we live on post COVID-19. It's going to be a very important milestone.
Sorry, guys, I lost you there for a second. Question to you, Damian, with regards to obviously the share market. So I've got a question here about, should people be looking at tech stocks and banking stocks given the current climate?
Well, I'll start with the bad side of it. As other people have been discussing, the banks have had to put on hold principal and interest payments. Landlords are obviously having to do negotiations as well. There's one comment that has come from the Treasury is, well, we're not going to wear all the pain. If you're a bank and you've lent money to company XYZ, you are going to have to wear some of the burden if that company can't pay its debt back. The other key thing is with the banks, they're all going to have to raise equity. And this is going to be an interesting thing that happened post GFC and will happen again. A lot of companies are already coming to the market asking for equity raisings to prop themselves up. We're likely to see the banks do that. So that financial sector, it doesn't make sense to be part of it, full stop. And that's coming from someone in the banking industry. Technology, healthcare. If we acknowledge what COVID-19, when I said it's going to change the world. Look, I remember a decade ago meeting a futurist, as he called himself, telling us about how technology would change the way we live, within the next 10 years. Well, a lot of things hadn't happened. I'm still walking into a shopping centre, for instance, not buying it fully online. I think what COVID-19 has brought forward the technological revolution by easily 5 years. That's why we're utilising Zoom. You look at companies like Microsoft, for instance. I know there was a very large scramble to get more data and more servers up in the cloud, more data there. I can guarantee you a Macquarie will not need 5 levels of office space in Sydney. It will be 1 or 2 at the most, and they'll enjoy me working from home. So what sectors do you want to be in? Healthcare, technology, and in technology, you can break that down into robotics, you can break that down into AI. Unfortunately, a majority of the companies in this space are overseas. The Australian technology companies are pretty expensive in comparison to their peers. But look, you can easily buy Johnson & Johnson, for instance, or Roche, the world's largest drug manufacturers, as easy as you can set up a term deposit. So don't think that's out of the question. One other thing, just totally away from shares, post the GFC, it was not shares that were the best performing asset post GFC. It was actually credit. So bonds lent to multinationals and companies which were at a discount. They were the first to rally, followed by the stocks in general. So don't think of the opportunities as only in Australia. Don't think about the opportunities only in the stock market. There's a whole array of them that are mispriced at the moment.
I think, yeah, it's important to note that, and you know, the changes that are coming. I mean, you know, it's hard to compare and say that, you know, this is similar to GFC, because it's something that I think that, you know, we've never really seen full scale before. So yeah, it's interesting. There's a question here. Do you think COVID-19 is masking the underlying issue that valuations have been too high due to low interest rates? You know, business confidence wasn't good for a while. You know, I want to have a stab at that one.
I don't want to take up the whole time. I'll let someone else do it, but I do have an answer if you want.
You're welcome, Damian. You're in front of the charts every day, I know.
Yeah, one of those first charts I put up clearly indicated that price to earnings ratios over a 20-year average were just well and truly overvalued. That's why I think the sharp fall in equity markets especially came really fast and quick. I do want to note that, you know, we are in a different world of low interest rates. Get used to interest rates being exceptionally low for longer, and with that, that's going to create opportunities in itself. But you know, ultimately, you know, Michael put a chart there of, you know, where people sit on, you know, the optimistic, pessimistic, so on chart. There you go. I'm actually Mr. Excitement, and a couple of clients always question me at this time of why am I Mr. Excitement. The opportunities out there, they're easily seen. There are a lot of panic sellers out there. There are a lot of people that have that fear and panic and are pressing the exit buttons on assets that are of ultimately high quality that will come out the back end of COVID-19 as winners. So getting back to that point, healthcare, technology versus banking. Yeah, I would have some problems if you had banks. Conversely, if you own some quality tech companies who are going to benefit out of this, I'm pretty excited about owning them at much cheaper prices.
Damian, would that include tech companies that obviously handle data?
Yeah, definitely. Data, the move to the cloud. So I use Microsoft. I use Alibaba. I use Amazon Web Services. All of those businesses have fallen by over 30% in value in their local currencies in the US. Look, my view is that their businesses, they don't want to come out and say we're net beneficiaries out of this. You just don't want to say that at the present moment. But their numbers are going to show that. Look, there's other sectors. If you've got totally no problems with ethics, I think the world is going to become a bit more nationalistic moving on from here. So we'll see a lot of defense spending as well. So look, there's just so many opportunities out there. Unfortunately, a lot of them are overseas. But look, there definitely are some local that are worthwhile undertaking. But I'm actually talking about these opportunities not being for traders. I'm talking this about being companies you buy and close your eyes for the next half a decade easily. So yeah, I think I'm Mr. Excitement.
I share the same excitement, Damian, because I think you know, although this is a virus, you know, I'm trying to be positive about it and calling it the innovation virus, because you know, you're going to see a lot of people exit, you know, their businesses, exit the markets and so forth. But it's the ones that are leading the way forward and innovating that are obviously going to come out better on the other side. So, you know, whilst we can all sit here and be upset and go, well, we're stuck in this world where, you know, it's doom and gloom, I think it's quite the opposite. You know, the opportunities are there. And that's the sort of thing that we're, again, pushing to our clients, is that, you know, for every disadvantaged business, there's an opportunity on the other side. So, you know, keep that continuity. One of the other questions there has come through is, you know, depression or recession, is it too early to see? You know, that's probably a hard one to answer, I suppose, but what are the thoughts?
Hopefully neither.
Hopefully. I think we're going to have definitely a couple of quarters of recession. Whether we're going to hit those lows of depression, yet to be seen. I think a lot of economists are already coming out and calling that we may not hit a depression, but I think recessions are definitely, a possibility.
I've got a comment here, which is nice to see. It's been a fantastic event, guys. You've all been super helpful. So thank you, Jono, for that one. I think that's pretty much all the questions. If I've left anything out, I apologise. You guys on the panel, did you want to sort of mention anything else that you're seeing, or?
All I'll say there is, it's important for those that are listening that haven't sought advice or have these questions ticking along, make sure they get the appropriate advice to get the questions answered by professionals. Don't make judgment calls about your financial situation. You've got to do it in an informed, from an informed perspective.
Yeah, this is my closing remarks. Is that it's a time now to obviously consolidate, to to take a pulse of where you are, but also to look at the positives that could come out of this: reskilling, innovation, use of technology, and try and put yourselves in a better position for when we find some normality again and some level that we're all going to be comfortable with into the near future. So yeah, just thanks, Michele, for the opportunity, and the boys, well done. I think it's been a great session.
Yeah.
I'll also just say, take advantage of this opportunity. We'll look back on this in years to come going, why didn't I do anything? I think that's the main thing we have to ask ourselves. What risks do we want to take? Because it is an opportunity, and that's for those that are invested in the market already, and for those that are fully cashed up. It's an opportunity we'll look back on going, why didn't I do something if you don't? So thanks again.
Yeah, thanks, guys. Like I said, I just want to say thank you to all the panelists tonight. Damian from Macquarie Private Wealth, Michael, Innovative Financial Solutions, and Sebastian from Wealth Depot. Guys, insights, informative as always. Really appreciate it. Can I also mention that obviously our Facebooks and YouTube and channels and so forth are all there for you to jump on. Please look up our YouTube channels for business updates with regards to stimulus packages. As we continue to get more information from government, we will continue to share that out on our social media. So please stay tuned. And again, like I said, probably Tuesday night, we're waiting on some information from government in regards to the rental situation. So watch this space. But again, guys, thank you so much for coming on. Really appreciate it. And for anyone out there listening tonight, please reach out to these guys. Now is the time to take action.